Hi everybody. Mapletree Industrial Trust have announced their second quarter or first half result in end October. Today we're going to look at their result and also we want to look at what is the growth prospect and future for Mapletree Industrial Trust. This is the headline press release of Mapletree Industrial Trust where they announced a DPU of 3.36 cents for second quarter, and they have a steady portfolio performance with improved occupancy and positive rental reversions. And the amount available for distribution has also grew by 0.7% year on year to 89 million. And they're also going to have a progressive release of 6.6 million tax-exempted income over the next 3 quarters. All this seems to be quite decent and good. Let's zoom into more detail to look into that. Before I look at the numbers, let's look at the properties available for Mapletree Industrial Trust. It have now more skewed toward data center. As from this chart, you can see that data center contribute more than 50% of their total AUM, which now stand at 54.6%. And the balance segment will be contributed by the rest of the various industrial assets like high-tech building, business park, flatter factory, step-up rent-up building, and light industrial building. And Singapore contribution have dropped below 50% based on AUM to become 48.7%, and US have inched up slightly to become 51.3%. From this statement of profit and loss, it's a year-on-year comparison. We have seen that actually their revenue have went up. However, their property expenses also have went up quite a fair bit. And the borrowing costs have went up 36.6%. This we can explain by rise in interest rate. But the net bottom as well, I will want to be more focused on is the dividend, the distribution per unit that as an investor will collect. Actually, it have dropped 3.2% compared to last year's second quarter. But that's a 1 year ago. Let's zoom it further to look at first half compared to last year first half. Overall, the DPU is actually flat. From one half to last year first half, is actually flat, but let's zoom in nearer to quarter over quarter comparison. That means that second quarter FY2223 to first quarter FY2223, which is the nearest one we can see. And ultimately, we have seen actually there is a huge increase in property expenses compared to their revenues, and also a 19.2% increase in borrowing costs. The costs have grown up, but the revenue didn't grow up as much. And this resulted in their DPU have dropped by 3.7% quarter on quarter. So in the near term, it don't look so positive on the DPU side. And whether for the Q3, Q4, will the DPU able to maintain or will it continue to drop due to current high inflation environment and also the interest rate rising? We will want to look into more details on that. Now let's look at their financial position. Their NAV have increased from 1.88 to 1.93. One of the reasons mainly as their net asset have actually increased by 3.1%. Their balance sheet side is pretty decent and strong as their current gearing is 37.8%, which actually is a slight drop from last quarter. For Mapletree Industrial Trust, actually they have this thing called dividend reinvestment program, and actually the take-up rate is pretty good. Currently have 42.9%. So when there's a dividend reinvestment plan, actually the risk manager slowly accumulate capital, and this capital in future can be used for acquisition or other purposes. This is their capital management. We can see that their fixed rate actually is pretty decent, 74.2. Is anything that's above 70% to me, I think is quite good. And their weighted average hedge tenor is 4 years. It is pretty high. However, the average all-in costs have increased from 2.5% to 2.9%. This, you can see that is the impact of the increasing interest rate, where average all-in cost of funding increased from 2.5% to 2.9%. Nevertheless, their interest cover ratio, although there is a decline from last quarter, but they are still within a very, very healthy range. Below is a table shown by Mapletree Industrial Trust on the interest rate increase impact to their DPU. So when there's a 200 basis point increase in interest rate, their impact on the DPU is 3.1%. And interest rate have actually increased by more than 200 basis points already, and it may continue to go up higher. So the negative impact to the REITs DPU is definitely, we can see from here. But it's how can the REITs counter that? As interest rate increase is just one part, that's on the borrowing cost. But we want to look at their revenue side and the cost cutting measure. Are they able to counter the increase in costs? The first concern, we look at their debt maturity profile. Do they have a lot of debts they need to refinance during this interest rate rising environment? Currently, they have another 11.9% as of 30th September. They need to refinance. It means that this is the next 6 months, they got 11.9% of their bank loans they need to refinance. And this will most likely definitely have to refinance at a higher interest rate. And for FY2324, which is actually start in March 2023, next year, they will have another 6% that need to be refinanced. So total, their debt that will need to refinance in the next 12 to 18 months will be slightly less than 20%. To me, it is reasonable and it's well managed on that. But nevertheless, this 17.9% of them will most likely have to refinance higher interest rate, and there will be a negative impact to the REITs on the cost aspect. So let's look at the occupancy. As if their occupancy were able to constantly improve and doing better, indirectly they were able to generate more revenues. This revenue may be able to compensate for the increase in cost. So the occupancy rate have remained stable when compared to first quarter 2223 to the current second quarter 2223 is stand at 95.6%, which is pretty good as at this current market juncture for industrial REITs. If they can maintain above 95% is considered decent. But let's zoom in further to look at the occupancy side, where the business park is 86.3%, is way below the 90% mark. But I think that will be the general status of business park in Singapore now. The occupancy rate is not really that high. However, the contribution of business park to the REITs is not very significant compared to the data center, where more than 50% of their revenue of the REITs is from data center. And we have seen there is a drop of data center occupancy from 94.5 to 93.8. And this will have more negative impacts to the REITs compared to the business park side, as the data center have more than 50%. The rest of the other assets hold up very well, is way above 95%, and all of them actually have increased or remain almost stable. Let's look at the Singapore portfolio performance for Mapletree Industrial Trust. Their rental rate have increased steadily from when the IPO at 2010. However, I have noticed that in recent years, the rental rate for these REITs was pretty stable. I mean, we don't see any upside potential. That will reflect actually Singapore industrial building status, and maybe that's one of the reasons why the REITs divest out to data center in the US side. Their occupancy rate in general have constantly remained above 90%. Except some of the year it dipped below 90, but in general they have able to hold above 90% as a whole for Singapore portfolio. So let's look at their rental reversion, the Singapore side. If they're able to increase the rent for renewal, this will mean that they will more income, and this will able to help them to compensate for the higher cost due to inflation and also the interest rate. From this table, you can see there are various types of assets for their industrial building in Singapore. All have received positive rental reversion whenever the tenant renew. But however, one thing to take note that the new lease, in fact, will be charged a lower rent. One of the main reasons is when new tenant come in, they will have rent-free rate, all these things. So in the new lease, the rent is lower. This also indirectly shows the current state of the industrial building sector. But we hope that those new lease, when they renew the rental, the next time the rent will go up. As what have been shown here, those renewal, actually the rental have increased over time. Let's look at the price performance of Mapletree Industrial Trust compared to STI and compared to the REITs index on a price return basis. So year to date, we have seen that Mapletree Industrial Trust and actually underperformed the STI by more than 20%, where STI give a positive return of 3.4%, but the REITs have dropped 18%. And it have actually also underperformed the REITs index, which have dropped 15%. And if we were to put in a dividend, this REIT also underperformed the REITs index total return by about 1% margin. We can see that this REIT is currently facing some challenges in the near term, as these REITs have constantly outperformed the REITs index since the IPO to today. But in this near term period, for this 2022, they have in fact underperformed due to actually mainly the recent big drawdown of the market, and they actually have dropped quite a fair bit, and they have actually dropped more than the market. But we look at their track record, they have actually outperformed the market by a big margin since they listed in 21st of October 2010 until 16 November 2022. Actually, this REIT have give a distribution yield of 143% and a capital appreciation of 148%. So total return is slightly less than 300% since the IPO until today. If you were to invest in this REIT when they IPO in 2010, the dividend you collected is more than your capital invested. The price down in the market is actually pure returns. Compared to the market, it have really beat the market by a big margin. But however, this year, they have underperformed the market, and we hope that this is just temporary, as not all REITs can constantly outperform market at all times. Next thing is their DPU. We have seen that these REITs, their DPU have not dipped based on year basis. It starts with 3.45 cents. That's not a full year. Then the full year is 8.41 cents. Then they increased to 13.8 cents. Although quarter by quarter basis, there is a dip, but annualized basis, they never dip. So this year, we shall see whether are they able to keep up with the last year DPU, which may be quite challenging at this juncture, where the second quarter, they announced a drop in DPU, and with current interest rate rising environment, the next 2 quarters, we need to observe whether the DPU able to hold or dip further. So to mitigate that, I think the risk manager have been doing something. They try to improve their portfolio performance, better capital management. But the most important part I just want to bring your attention is this release of 6.6 million of tax-exempt income over the next 3 quarters, from third quarter onwards, which is now, October 2022 to December 2022. They will release a 6.6 million over 3 quarters. If I will divide evenly over 3 quarters, it's 2.2 million. So their distribution income in general is slightly about 85 to 90 million. So by distributing of 2.2 million over 90 million, practically they are just trying to maintain their DPU from dipping. If everything the same, compared to look at their quarter over quarter, DPU have dropped 3%. So where the interest rate increased by 200 basis points, their DPU will drop about 3%. So this 2.2 million to me is more towards mitigate the downside risk of the DPU. But how much were you able to cushion that? This is something we will want to observe in when they announce their third quarter business update. But you have a longer time horizon, this may be just short-term volatility and short-term market condition. But we are looking at the long-term growth on that. We also want to look at this REIT. Are they able to navigate through this current market situation? And one thing very important is the sponsor. Is the sponsor able to help them? And currently, they have a very reputable sponsor, which is Mapletree Investment. We have a global presence. And this REIT currently have a pipeline of a group of data center, the Mapletree Rosewood Data Center, where they currently only own 50%. They can acquire the other 50% interest from the sponsor. This may be able to help in the DPU grow, but unlikely they will be able to exercise it at this juncture, as the interest rate is rising, the cost is going up, and data center currently the yield may not be that attractive. So although they have the pipeline to acquire this 50% interest of this group of data center, we may not be able to see in the near term. And the only way they can do it is mainly through AEI at this juncture. Okay, but AEI will take time. Let's see how the sponsor actually have helped the REITs to grow. If there without this sponsor, I think these REITs will still be stuck in Singapore, just be a pure Singapore industrial REITs. And I think there will be some restriction in that in the growth perspective. From this table, you can see that Mapletree Industrial Trust started in Singapore as a pure industrial REIT, which only at 2.1 billion AUM in 31st of August 2010. 12 years have passed. This REIT have increased their AUM from 2.1 to 8.9 billions, and you can see that there's one very big asset class. Data center have become more prominent, taking over, become the core contributor to these REITs. And the high specification building, this is what we want to look at when it comes to industrial REITs. Initially, you only start at 21%, now have increased to 77.4%. And thus, this REIT have transformed over the years. This definitely is with the help of sponsor. And currently, you have 85 properties in Singapore and 56 data center in North America. And for the data center in North America, more than 90% of them are on a triple net lease structure. Triple net lease is usually applied to healthcare REITs. the hospital. For the data center in Mapletree, more than 90% are on triple net lease. And actually, this will reduce some of the stress from the risk, where triple net lease is the maintenance, the tax, and the insurance charges are bear by the tenant. And what the REITs do is just collect rental, and the rental formula is usually kept with an escalating formula, which means that their dividend, the rental collected from the data center will be increasing. Thus, what they need to do is try to have to maintain very high occupancy rate for the data center, which will be very positive for the REITs. And the next one is there is a redevelopment of Kolo Aya, where they have increased the plot ratio from 1.5 times to 2.5 times. However, this development is still in progress, and thus it may not able to help them in terms of their DPU in the near term in the current interest rate rising environment. But we know that in the foreseeable future, we were able to see the income from this development coming, as the expected completion date for 165 Kallang Way is second half of this year, and 163 and 161 Kallang Way is first half of 2023. Although you say that you're completed by second half 2022, they will still take time for the tenant to move in, and still take time for the renter to come in. So we may only see this positive impact to the risk maybe on the second half of 2023. Thus, in the near term, to me, at this current market environment, it may be quite challenging for these REITs to keep their DPU from dropping. But I can see that in longer term side, with all these pipelines and with a strong sponsor and with their AEI project, we should able to expect long-term wise their DPU should able to continue to grow. That's all I have to share with you. And if you feel that this video have benefit you, do remember to like and comment, and also share this video. Lastly, do remember to subscribe and press the notification button so that you'll be informed on my next video. I shall see you in my next video. Bye-bye.